Look at these two numbers, $24,000 and 3,000 hours. That is exactly what it cost me to realize that 90% of what you see on financial YouTube is not suitable for me. For 3 years, I was the guy drawing magical lines on charts. I traded crypto, forex, and options. I thought I was hustling, but in reality, I was just a hamster on a wheel, paying insane fees to brokers, paying massive taxes, and slowly destroying my mental health. Then, I did something that felt completely wrong. I stopped trying. I deleted my trading apps, I sold my individual stocks, and I put every single dollar I had into one boring 3-letter ticker symbol, VOO. And something infuriating happened. The moment I stopped trying to beat the market, I actually started crushing it. Wall Street profits from your confusion. They want you trading actively because that's how they get paid. In this video, I'm going to expose the math behind their lie, show you the hard data, and reveal the exact lazy strategy that is quietly making regular people millionaires. Let's dive in. Most beginners think the only cost of trading is the money you lose on a bad trade. They are wrong. There are 3 invisible killers in active trading. First, the tax drag. In the US, short-term capital gains are taxed as ordinary income, up to 37%. When you buy and hold VOO for years, your money compounds tax-deferred. You only pay taxes when you sell, decades later. This difference alone can be worth hundreds of thousands of dollars over a lifetime. Second, the spread and slippage. Every time you click buy or sell, the market makers take a tiny cut. If you trade 100 times a year, those tiny cuts become a massive wound. Third, the opportunity cost of time. If you spend 20 hours a week trading and make 10% a year, but the S&P 500 makes 10% while you sleep, your hourly wage for trading is effectively 0, or worse, negative. Let's talk about the professionals. Many people think they need to hire a pro to manage their money. Let's look at the SPIVA institutional report. Over a 15-year horizon, nearly 92% of active large-cap funds underperformed the S&P 500. Why? Because of high management fees, usually 1% or more, and the simple fact that the market is highly efficient. In 2007, Warren Buffett bet $1 million, but a simple Vanguard S&P 500 index fund would beat a basket of hedge funds over a decade. The hedge fund managers chose their best ideas, used complex algorithms, and had secret data. By 2017, the S&P 500 was up 125.8%. The average hedge fund? Only 36%. The average annualized returns over 10 years were 7.1% and 2.2% respectively. Buffett won because he chose a self-cleansing system with almost 0 fees. Now, why specifically VOO? Why not QQQ or individual dividend stocks like Coca-Cola? Sector diversification. QQQ is heavy on tech. If the dot-com bubble happens again, QQQ investors could wait 15 years just to break even. VOO includes healthcare, energy, financials, and consumer staples. It's the entire engine of American capitalism. The power of 0.03%. Most active mutual funds charge 1% in fees. If you invest $100,000 for 30 years with an 8% return, a 1% fee costs you $250,000 in lost wealth. With VOO's 0.03% fee, you keep almost all of it. That's the price of a house, lost to fees. Investing is the only area of life where less effort often results in more profit. In your career, you work harder to earn more. In investing, the more you do, the more you pay in fees and taxes. My life changed when I stopped looking for the next big thing and started trusting the 500 biggest things. I no longer wake up at 3 a.m. I spend my time with my family, my hobbies, and building this channel. If you want to start your journey, don't overcomplicate it. Set up a recurring buy, pick VOO, and go live your life. Wealth is built by waiting, not by trading.